A supportive Federal Reserve to some extent, removing accommodation at the pace of a snail, I would say, and then a market seems to be okay with everything. That the story?
That is the story, and you obviously see it not only in the equity market indexes, but in the VIX. I mean, the volatility, and for us, when we think about risk and reward, it's the times where everyone thinks that the market is bulletproof, that there is nothing to worry about, when we do get a little concerned, because if you look at the last 8 or 9 years, the market has been constantly fed higher by climbing the wall of worry, which has tended to come with corrections along the way.
You've tended to do quite well of climbing the wall of worry for a long, long time, though. So why is now different?
Valuations are at peaks that we really have only seen during the tech bubble. What we're starting to see is, a little bit of lagging small cap stocks crowding into technology. We're not saying that's a bubble. It is something that we continue to like, but we do note that the leadership is becoming narrower, and these are concerns that seem to be below the surface. But are worth noting.
Julian, how important is it that we're living in an environment we've never seen in terms of central bank monetary stimulus? I mean, are we climbing that wall of worry on a lot of cash, euros and dollars that are being thrown into the marketplace by the central banks?
Well, what I would say there is we have climbed that wall of worry to a great extent over the last 8 years, and now we're in a situation where the world's central banks are starting to remove that, and it's sort of the tide is coming out, and all of a sudden, to us, it's more than coincidence that the last 4 spikes in volatility over the last year have all been because of political events.
Well, exactly my point, which means if in fact people are wrong in overcrowding this bull market, will it prove to have been because central banks have pulled back?
That could certainly be part of it. Central banks can pull back, and the markets go higher, and we think that will happen. But everything else really does need to go in this environment, at these multiples, at this level of VIX. Everything needs to go right.
Mohammed Al-Aaron of Bloomberg View writing this morning about how you characterize this trade, a reflation trade, a liquidity trade, or is it just the Trump trade? And he's saying it's very much the liquidity trade, with the following quote: with the political implementation outlook having gotten more complicated and likely to remain so, the current rally is essentially a liquidity trade amplified by a reflationary flavor. To develop a much more robust underpinning, it would need to be anchored by stronger global reflation and better prospects for pro-growth policies in the US, the evidence for which is not overwhelming, at least for now. The pro-growth policies that we all thought we were going to get, I ask everyone what their base case is now. Their base case is not a lot, yet the market still seems to be holding up, even though that is the base case of a lot of people. Why?
So we've reverted back to this environment where 10-year yields being suppressed at 220, 225 have fed into the growth stock story, whereas, of course, everyone was positioned for the value stocks coming into the beginning of the year. We agree with that statement. What we would like to see is the market get a little deeper and rotate and perhaps get yields moving higher as an acknowledgement that we're going to grow north of 2% this year.